6,000 options contracts at the 7 strike puts. Is this bullish or bearish? Because if they bought the puts, then they're bearish. But if they sold the puts, then they're bullish. So in this video, we are going to analyze these unusual options and determine what this large institutional investor is doing. Because we have earnings coming up on May 8th. That is tomorrow after hours. Today is May 7th. It's a Sunday. The market is closed, but we can take a look at the last day of the trading period, Friday's unusual options, which is here, May 5th. And so these 6,000 contracts are the most significant, because if you were to multiply out the second one like this one, these calls here, if we were to multiply that out, 2,586 contracts times the $5 price, this value is only $12,930, which is not very significant and not necessarily a large investor. Same with this one, $25 times 1,358. This is only $33,950, right? So what about the other one? $99, 6,000. How much is that? $594,000. So this looks more like a large institutional investor putting on this trade. So we want to focus on this one. This is quite unusual to be putting on this trade before earnings. So as we can see here, this was done for the November 17 expiration dates. So these are a little bit far out, and we believe the reason why they had done a 194-day expiration is because they did not want to have the volatility affecting their transaction. Because if you buy or sell a option contract that is closer, like this is the closest one, May 12th, the volatility is very high at 134%. You'll see as we move away from that earnings period, the volatility drops. Okay, and so for the November 17, it's much lower at the 64%, and so that's one of the reasons why we think they are choosing this expiration date, a further away dated expiration day. And this then also leads us to believe that because they're choosing a volatility that's lower, that they are buying the 7 strikes. So here you see the volume 6,000, much greater than the open interest. So these are opening orders. And by looking at the price and looking at the market pricing that they got, $99, we believe this is a short position where they had bought these 7 strike puts. And you'll see here when we analyze this trade will gain in value if the price at 7.43 goes down on the x-axis, because it will be above this purple, and the blue line is all above that 0 profit loss on the y-axis. So you'll see it increases as we drop in price. The theta is slightly decaying, very little, and that's one of the benefits of buying puts or options or call options further dated away, is that the theta decay is minimal. And so our analysis of this is that Palantir, after earnings, has a good chance that it is going to drop below 7. So let's kind of zoom out to see, has it dropped? Yes, it has dropped below 7. In the beginning of the year, it was only about in January that it broke above this 7.3. So we are actually at a very strong resistance level. You'll see here we have tested this resistance also at this time. So here in February 10 and also in March 13, we had tested this resistance level. And so this is a concern for this large investor. And so they bought these 7 strike puts. Now, that doesn't necessarily mean we are going to short it, because they could have also had, for example, when they bought this, they could have created something like this. When you analyze this trade, this is a, let's take off that put and just analyze that. This is a covered, put strategy. Basically using the puts to cover their shares, to hedge in case the stock drops, right? And so after earnings, there's a chance that maybe it does drop, right? But their loss will be minimal. Compare that with, let's say we were to buy the 100 shares, right? Without buying that put. You'll see the difference here, why they would want to buy these puts. So without the puts, this is what it looks like. They're they gain in profit as the price goes up. This is above that zero line again, right? Here we are, that zero line. And so let's say we're at 7.43. Let's say it drops to $6. Their loss on their 100 shares of stock, per 100 shares of stock, is $142.88. Let's make sure that expiration date we're looking at. Okay, so same thing though, because stocks don't have a theta decay, so about that much. Negative 144.01. Now if we look at the other trade at $6, you'll see, look at that. Look at that, only $81. So that's the advantage of buying these puts, is that they reduce their risk. So so you'll see that difference. Again, we'll show you it again. Quite a difference of reducing their risk. So that is also possibly why they had bought it, these puts. Because you'll see that the reason why you don't necessarily want to short it is because if the price does go up, they are also going to be profitable, right? So they'll be profitable. It's just that they had paid for these puts as a hedge because they are concerned. And so there is a chance that it will still go up as well. So we have to continue to monitor the data. But currently, the question is also to ask is, well, is there a reason why they wanted to hedge to the downside? Is there a reason why this $7 strike price may be breached? Why does this large institutional investor have a belief that it could be breached, and why they want to hedge? So that is also something to take into consideration. And so we will be monitoring this data as it comes in. So tomorrow will be the last day to trade Palantir before earnings. So if you want any updates, if we see any other updates, make sure you are subscribed and you hit the bell icon so you will be updated. If we do make a Palantir trade, we will maybe we'll be able to make a video if we have the time to do so. But that is our current analysis right now. And so, yeah. If you found this video to be helpful, please subscribe, hit the bell icon, comment below on what you think will happen to Palantir for earnings. We're very curious to know. And yeah, so yeah, take care everybody, and have a good weekend. Last day before we start the market tomorrow. All right, take care. Good luck.